सुप्तेषु जागृति कामं 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 कामुषो पुरुषो निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता
Thank you. Good evening, everyone. I am Naveen Raj. I have been working with BSR as an associate director, which is an associate or affiliate of KPMG. I've been handling this Ind AS transition in the first phase for most of the listed clients. One at the initial stages, where we evaluate the impact analysis. Second one, when they actually moved into the financial statements. So, if you don't mind, can I not use this? Part of our transition, and I want to hear from So not that I wanted to talk everything from myself, I wanted to hear from you what you have faced as an Ind AS transition issues. But while we are having this, I will also give you a lot of practical issues. I wanted answers from you. I am not going to give you the answers. While I will give you the answers, but I wanted to first hear from you what you believe. I mean, here Ind AS is something, let's have it very, very simple. It looks very, very complicated, but it is not. Except for the disclosures and the financial statements, it is not actually very, very complicated. In the current scenario, it becomes very, very relevant, considering a lot of things happening in the economy and considering a lot of things which the global is seeing as very, very prominent economy. So that way it becomes relevant. We match them in every aspect. So that way it gets importance. But having said that, it also has its own little more complication from what we have been doing it on revenue recognition currently under our accounting standards. So before I get into the topic itself, as a profession, there has been a lot of changes which I feel which has happened in 2017-18. What are all the challenges as such the members faced? Can you give me some glimpse of what we have faced as the challenges? I just wanted to hear from you what are all the challenges we faced as part of 17-18. GST, yeah, that is a significant change. Yeah, every client had an issue in GST. So, any other challenges? GST is one. Demonetization, yes, the effect of demonetization was there in this year. Yes, our clients faced a lot of issues, specifically on, in fact, if I have to list down some of the sector, it is primarily financial services sector, retail, real estate sector has impacted a lot more on this. Any other thing?
Cost of inflation.
Cost of inflation, yeah. Cost of inflation, yes, it has impacted, but as such, don't you think the economy is growing? I I mean, I consider the cost of inflation, but economy as such is growing. Okay. Yeah, it was a slow growth, but I think it is picking up is what we feel right now. I mean, we are energized towards in the picking up the economy. So what else? What else? Any other? Index. Okay, index itself is an issue. So what kind of a challenges which you face with respect to all these things? So before we get into topics, let's have what are all the issues as such.
We have to get ourselves updated.
Okay. Why nobody said Nirav Modi? No, it is an issue. It is an issue which, see, if I have to think, there is a statutory change which is impacting us significantly, which we have to get updated. We have to advise our clients. Second, there is a set of things which is happening, which we would not like to happen the things in which it has been happened. So that way, who is being questioned in every aspect? The first thing, the soft attack comes first is auditors. I mean, it's while thinking back, every regulator has gone to PNB. I'm just taking PNB as an example. In every aspect, it is an issue. Every regulator, every shareholder has gone to PNB. But first attack came from everybody is auditors. So that way, so there are a lot of, while we carry a lot of responsibility with us, there is an easy attack which is happening from public on us. So that way we have to be very careful in doing. I mean, what I believe is we should be very careful in signing off these kind of financial statements. While we do our processes, while we do our things very seriously, there is always a chance that the other party is little more smarter than us. So that is what it has been done. I mean, nobody has identified, but first attack came on us. So that way, while it shows what is the responsibility we have it in the society itself. So that way, they carry a lot of respect. So anything comes into an effect, they come into. NFRA is something which is coming up. So how it is going to shape up, we have to wait and watch. But that is something which is coming. So as such, if I have to consider on overall scenario per se, there is a regulator who is pushing us. There are various technology related stuff which is hitting us. Third thing, the regulator is also coming out with various bodies to monitor how we are auditing. So that way, it is a crush from every side. So how to overcome it, we have to withstand this pressure. We have to, while we as an institute do a lot of things on this space, but as members we have to withstand this pressure and we have to come out of this in a way everybody likes. That is, we have to gain the public trust. One thing which I can think positively on these things is, while we have been blamed in many scenarios, but there has been an increase in public trust as well. So as a profession, there has been a balance on this. So we have to start gaining more public trust on these scenarios so that it gets into a very positive scenario. That is where we should head towards. That is my ultimate feeling. I mean, that is why I am here. That is why I am being a member of this institute. I wanted to be my institute to be seen as a premier institute. While we have been seen that way, we wanted to gain more trust so that it gets into a little more things. How we can achieve that? We have to be very clear in what we are giving as a clear. So there is some level of clients has also need to change. The mindset of the clients has also need to change. It is not only the statute. We cannot do everything by ourselves. We have to be relied on the client. There has been a push from the client side as well. So we need to ensure, educate the client in such a way that they also change towards these statutory and requirements of changes in the corporate world. So that way there should be a balance in what we are going to do, give us a responsibility in these kind of scenarios, and what the clients are going to deliver on this. With this background, with respect to now moving on to specifically on Index, let me tell you, at least 90% of the clients were not ready with this change. So first of all, the financial statements, which was around 30 to 50 pages, has drastically increased to 80 to 90 pages, which is primarily on account of increased disclosures. So while we say it is a transparent disclosures, there were some disclosures which everybody started feeling this little too much. We have not got that mindset of changing towards a new standard. So that way it is getting into a lot more information. How will I get it? It is the client's responsibility. First, we should tell them just owners on the client. That way, there is a gap between what is the client's understanding and what we are as auditors. So we cannot do everything in this way. So considering this, now I will move on to what revenue recognition standards requires us. As we speak today, there has been another standard which is going to get replaced both these accounting standards, which we are going to discuss this evening. It has been notified today, Revenue Ind AS 115, which is not drastically different, but yes, there is a significant impact in certain areas. I'll just tell you what 115 gives us. It gives us more guidance towards certain areas for which there is no clarity with the current standards. But having said that, I am not going to cover 115 as part of this session. I am going to cover what was the erstwhile or what will be the standards which will be acceptable for 31st March 2018. So that is what it is. So I'm not going to touch upon 115. But having said that, from 1st April 2018, it is revenue standards will be Ind AS 115, which will be a 5-step area. Now we are covering only the 3-step process. So now I will move on. What is that I am going to cover in next 1.5 hours or 2 hours. So these are all the standards which, so if you don't mind, I will just walk down. Okay. So these are all the standards which we are going to cover. We are going to cover Ind AS 18, Ind AS 11, more the construction contract and revenue recognition on sale of goods, rendering of services. We are not going to cover 104 insurance, 17 leases, 109 financial instrument. These also have certain level of income which will be recognized in the financial statements based on the standards. So that way I am not going to cover on all these standards. But yes sir.
115 is going to be one standard dealing with both 11 and 18?
Yes, it will be one single standard which will be covering both 11 and 18 and some parts of these things as well. So it will be interlinked. The principles are laid down in such a way that it doesn't differentiate the revenue on services as well as the goods. It says what will be the performance obligation. While this standard also deals with performance application, there is a lot more clarity which has come in 115 as a performance obligation. So we don't have currently, at least we didn't have any great guidance in the current standards on performance obligation. What will be a performance obligation? While it covers.
Can you give an example?
Okay, so I have the examples. I will take you through what is the performance obligation in the later slides. So we are covering today only on Ind AS 18 and Ind AS 11. So what is the definition of the revenue as per Ind AS 18? Okay, so a revenue is a gross inflow of economic benefits to the company, and results will increase in equity, and it will not be a contribution from equity participation. Meaning any revenue or any receipt towards a contribution towards equity will not be covered as part of revenue. This is a simple definition of what the revenue is. So that way. So what is the step-by-step approach? Sir, any questions if you have, please stop me, raise your questions. Okay? So that way I'll be happy to answer these questions so that it gets into more of a conversation. Okay? How it is identified? There are 3-step model which has been listed down on revenue recognition. What is it? First one is identify a component. What is that I am going to sell or I am going to deliver to my client? I mean, here I talk about a company and his customer. Okay, so that way, what is that he is going to deliver as a value to his customer? So that is becomes a relevant. You have to identify what is that component. Second thing, if there are multiple components in a contract, you should have to allocate the consideration to each of the components. So it is not easy. I will not say that the entire being seen as one single contract. There will be scenarios where you have to split and see. I'll come to the examples little later. I'm just trying to explain you the concept, then I'll come to the practical scenarios. The third is recognize revenue based on this. The one point which is common, there is no significant change between what we currently have in the IGAP vis-a-vis the Ind AS with the current standards. But 115 has a significant issues. So that way there is a change. But having said that, I will just try to tell you, link it to the current IGAP so that it is easy for us to appreciate what are all the changes. So linking a transaction. So when there are two transactions, so I enter into a contract. Okay, I'll give you an example here. So there is I'm basically a service provider as well as a equipment supplier. Service provider is meaning the erection of the entire equipment. I enter into a contract to supply the goods. I also enter into a different contract to erect the same into a equipment. So there are two different contracts. But while I have an internal things, I see both these things into a one single transaction. I would have estimated a revenue of say 100 crores. So when I'm splitting it, I would have given, because my equipment supply is going to come first, I would have said 90% is based on the equipment value, 10% is for my service value. While actual cost may not reflect the same percentage. So whether I have to link both these transactions or split and account. Suppose, assuming I will split and account, then 90% of the value may not represent the cost which I would have incurred. So what the standard says is, if you believe without this component will not serve the customer's request, then please link these transactions and see it as one single contract. If a component which is being supplied can have an independent value, with whether erecting it or not erecting it, or he can go to a third party and erect it with the same price, then it has a value to its customer. So that is how a component needs to be identified. When you said what is a component or a performance obligation, this is what is the performance obligation. Whether this item on a standalone basis, can it give a value to a other person? That answer, if it answers yes, then yes, you can split it. Splitting will also be once again questioned whether it is at the fair market value. It cannot, one cannot be unrealistically high, the other cannot be unrealistically low. So there is a lot of judgment which has to be involved in implementing or analyzing each of these contracts. So that way it becomes more onus on the management to justify why they believe these two transactions are at a fair market value. While the responsibilities are in the management, as auditors, we need to have to challenge these positions and then get to a right answer. Because once, if you believe that the company is going in a wrong direction, then you have to stop at that first point itself. Because then it becomes 2 years issue, it is not one single year. I would have supplied in one single year where I would have made huge profits, and in the second year, only the services are there, but my cost will be on a higher side, I would have made the losses. But it is not fair also. So that way, while the owners is on the management, if they are not with very transparent way, they would like to play with these judgments. But we as auditors, we need to challenge these things and come to a right answer. And there are guidances how to split a contract, how to merge a contract. So that is what the basic concept is. Whether it gives a value to him on a standalone basis, whether the erection can be done by any other party irrespective of me doing it or not. It may be incidental that I would have got this contract. Clear? At this point everybody is clear what each component, how to split a component. Clear? Any questions? So this is what it is. Whether the segmentation, how it is, whether value to the customer is individually. So I wanted to take you through this one. Are the Ind AS segmentation criteria is met? Yes, separate revenue recognition. Does not deliver an item have a standalone value to a customer? No, then check this. Yes, then you move whether it is a fair value. There also, whether even if it has a value, you have to check whether it is fair value. Because this is entered into as a one single contract. So that way, whether when we are splitting it, we need to see whether it has an independent value to the customer, as well as we need to split the consideration into fair value. Clear? The fair value can be split into based on the fact. So suppose there is a cost of 100 crores and the fair valuation of each component. I go back to my same example. One is on the services and the other is the equipment supply. The fair market value of equipment supply is around 60 crores and the fair market value of a service, if I would have done only the service, I would have charged 40 crores. So that way it is 60-40%. So I should split the consideration into a 60-40 ratio, even if does not add up to the fair value. I will give you a different example. Suppose it is an equal. For example, for a supply of goods I spent 60 crores and for services I would have given 60 crores. If it has been two individual separate transactions. But in this case, I would have charged 100 crores. Because he's come to me as one single bundle. So I just wanted to give him a 20% or 25% discount. So I've given him at 100 crores. So now we need to see whether what is the ratio at which we need to split. Because it is an equal percentage, 50% on service, 50%, we need to split the consideration in the same 50-50% ratio. Which means 50% for erection or supply of goods and 50% for the erection services which we are rendering. So that way there is a clear guidance how to split the consideration into two buckets. So it is also on the basis of fair market value. There is nothing. So one, okay, on a lighter sense, if some clients ask you, how do you want to value this, or how do you want to measure something under Ind AS, I will generally say it is fair value because it will be generally correct. Because everywhere it speaks about the only fair value. Generally, if you say fair value, it will be correct. Everywhere it says it is fair value. Why? I will tell you the background also. So, what Ind AS tries to do is, every transaction has to be recorded in the books in the spirit in which it has been entered. Meaning, suppose for example, I have I'll give you some other, okay. So there is an example of a loan being given to a customer. There is a processing fee which I collect. Why am I collecting a processing fee? From the company or an NBFC or a bank perspective, they see this as a revenue from this loan. Revenue from this loan. They don't see whether it is a processing fee. I get an upfront income, that's it. And get an interest over a period of time. Both are revenue from this loan. That's how it is. So what it says is you use an effective interest rate model to recognize this income, because that is how it has been recognized as an income. So the objective is you are given him a loan, you want to earn an interest income from him. What is the crux of the transaction. So it goes beyond whatever you say in the agreement. That is irrelevant. How you should account it is effective interest rate method, which means that you will recognize income as and when he reduces. Both processing fee and the interest income has to be combined, and it has to be on a written down basis. It has to be recognized. You will revise the interest rate percentage. So this is a significant impact on financial services as a sector. Every banks will undergo this issue because they have been upfronting all this income. Now they have to, over a period of loan, they have to recognize. This is a significant impact in the financial services sector as such. So any questions until now? Question? You have something?
Clear about impact of the financial
services sector. Okay.
Can you elaborate?
Okay. Suppose, for example, I get a 2% upfront income from a customer, and I, over a period of loan, I get an 18% interest income. Say, for example, 1 lakh of loan. So I get a total revenue of, for a 1 lakh loan, I would have got initially 2,000 rupees, and then over a period of time, I would have got 20,000 rupees by way of an interest income. Now, technically, if you see, for this 1 lakh, I would have got 22,000 as an income, right? Upfront, this 22,000 should be spread over the life of the loan. If it is a 2-year loan, it should be spread over 2 years. But what we have been erstwhile doing is 2,000 would have been recognized upfront, and balance 20% would have been coming down over a period of 2 years. Now instead, this entire 22,000 has to be spread over the 2 years period. So the income which has been recognized in the prior periods will get reversed now by hitting the reserves. Because on transition date, you have to reinstate everything, and then on go forward basis, this will be coming to the P&L as an income. While it may, on transition date, it may look beneficial, but in the long run, it is hitting them badly. You cannot upfront the income. Got it?
Like so bank is given a term loan for project from 5 years period.
Yeah.
And now the party customer wants to repay early, like prepayment. So in that case, like 50% they have recognized, like 2.5 years has gone, 50% they have recognized. So what about the rest 50%? Because they will not repay to the customer.
Correct. So I agree. So that 50% it would have not been exactly 50%. I'll tell you why. Because it would have been a running down on basis. So it would have been 60 or 65%. Because in the initial period you will recognize. But having said that, in the pre-closure period, you will recognize the balance income on that date. Because the contract is getting cancelled and you don't have any obligation. So that is an event which has happened, which has triggered you to recognize that revenue. Because you are cancelling that contract. And you will also receive something called pre-closure charges, which will all hit in that period. So it's an event. That event has triggered with this transaction. Any other questions?
So they may charge less amount initially.
Yes, technically your revenues will go down in the initial period.
But even companies also a little bit of that, no? Because they will charge less every year.
They will charge the full amount, but they will recognize later.
Later, they will start recognizing that revenue later. So you will have a slight increase in the subsequent years, but the initial year, yes, there will be a.
Actually, what's the relevance actually? Because we have already got the money, and we are not going to refund that at a later point of time. So what's the relevance here?
So relevance is, what is the objective of that transaction? I don't render any service to give a processing fee. While there is some level of documentation and this one, what is the crux of the transaction? By doing documentation, the customer does not get any benefit. He is getting benefit only out of that loan. So that loan has to be, if that loan revenue is spread over a period, then this 2,000 should also be spread over a period. And okay, there is one more argument to it. Having now got you to some clarity, I wanted to confuse you now. Okay, so if there is a agency which is identifying a customer for me, I pay him a 1% or 1.5%, for which I am collecting 2% from this guy. Now there is a guy who is doing us this service. So then there is an argument that this 2% is not relating to my documentation or this one. There is a person who has identified these customers, so I have to give it to him. Having said this, in 115, it is totally a different scenario.
Unless they have to.
So I am not going to touch upon 115. Next time when I am talking about 115, I will clarify you on that. But you cannot assume that this will be an accounting treatment on go forward basis. We will have issues in 115 in a different way. So I don't want to confuse you with a lot more concepts. Let me go one step at a time. So 115, there is a chain. You please know that. If people are interested, please go and read it. It will confuse you because just now I have said this concept. Now I will deviate from this concept. So it is not going to be easy. So that way, someone was asking some question. Sorry, it got clarified. Any other issues which you have come across in revenue recognition which you wanted to highlight? Before I move on to some of the practical issues. I mean, no more theories. Let me put it that way. I will not touch upon any more theories. It is going to be more of practical issues. I have some 4 sheets to discuss all practical issues.
For example, in case of a company constructing apartment and selling, so whether it will be treated as a revenue or it is a construction.
Construction of apartment and it is treating it as real estate basically. So
not real estate, construction and development. It is not buying and selling as it is buying, developing and selling.
Super. So the answer to this is I will split it into 2 parts. Okay. If I have identified a customer and the customer gives me a design, I do him as a construction contract per se, then the revenue is based on POC. Okay, in simple terms, because he is controlling everything and I am doing it as a service provider for him, and there is a specific contract. It is like an erection service. If I develop entirely and I deliver it as a unit of house to one person and his obligation is only to see the house and he doesn't bother about how I construct, how I design, I don't give him an option to design everything, then it is a unit of sale. So until I construct it and bring it to that level, it is my inventory. Okay, it becomes what is a performance obligation here is I have to give him the unit of house. Until then it is my responsibility.
So till handover it will be inventory.
It will be an inventory. So there is a in real estate there is 2 scenarios as possible. One is that it can be a simple POC kind of a transaction, or it can also land up to a unit kind of
POC.
Percentage of completion. So percentage of completion method, it can fall into the percentage of completion method. In another scenario, it will be a unit kind of sale like any other sale of goods.
Percentage of completion will be if the buyer has a say on the structural design or he is...
Everything. It is like I become a contractor for him. I don't own anything. Even though I help him identify the land, everything I do, but I do everything on his instruction. He gives me an instruction. You identify a land in Bangalore. I want to construct an SEC zone. So then he says this. So I go and identify a land. I show it to him. He says, yes, this is okay. So I buy on behalf of him. Then tell him this is my structure which I am planning. So you approve it. No, I wanted to change all these things. I want this place here. I want this place here. So when he designs everything, then it becomes that I do a subcontracting for him. While I do lot more things, there is a subcontracting which I do for him. So that is how it has been seen. Okay. Clear? Everybody clear? Any other questions?
In that case, if suppose he purchased some quantum of cements and he has ready stock, what it value is then?
No, stocks for the subcontractor.
Subcontract.
It is my raw materials. It is my raw materials. It go, so anything which I have not used will be my raw material. But generally, what these guys do is they will put it as an expense and they will do it as a bill. So the raw materials and WIP does not have a different value. Everything goes into the construction.
Income tax laws have a different way of looking.
Sir, income tax has a totally a different way. Now ICDS with Delhi High Court confusion, lot more confusion will come up. At this point, we will not touch upon income tax related to this one because income tax may see this totally different. Because I will tell you a scenario in one of our client, okay, I would have got an advance. Sir, I will come to you. Just give me a minute. They would have got an advance for this housing unit. So they saw this as a revenue. They saw this while these guys have said this is only an advance. I have not even constructed the house.
But they won't give the benefit of payment to cost of inflation. They say only when title is passed.
So this is so income tax. We cannot tell them about this standard because they go based on the revenue for the government. So their perspective of seeing things is totally different. So you cannot combine both these things. They see with the green glass and we see with the black glass. So there is a difference between both these things. We cannot come to a common consensus.
GST. They say when option of claim is given, that's gone.
That's gone. So everybody having a different perspective of each transaction. So that way, on go forward basis, what I believe is where we should head, or ideally where we should be is, it should be one single standard, and everybody has to accept this as a standard. So unless otherwise we reach that position, it is going to complicate our lives.
For example, Bombay High Court, Bombay takes when a building is done, 75% is material, 25 is services.
Correct.
They will take
that. So there are various other states do this. I think Gujarat has a different percentage, but it also has a similar percentage. They don't see what has actually gone, so they have no relevance in this state. Now, having in GST, I don't know how these things are working. I haven't seen that way because it is.
Today I was reading a circle which was saying that canteen services are charging for the sale of goods, that is food. But there are dishwashing, cleaning, other thing done. This should be taxed as services and other side should be taxed as goods.
I will give you one more example because you touched upon GST. In tractor industry, okay, the components are charged at 18%. While the tractor itself is around 10%. So the input credit which I have, I will not be entirely using it in the tractor. So that way there is a constraint. They will have a huge refund piling up in that balance sheet. How they are going to get it, nobody knows the tractor. So there is a constraint here. If he is only operating in a domestic market, he will have constraint. How he is going to recover this money? While he is legally eligible to get this money, he will not be able to use it. The company cannot use it. There are gaps. I think the industry is representing to the government. I think it will see. This is a 9 months period which has gone for GST. I think a lot more dust will get settled down as we get little more mature. I think government is in the right direction. I don't know whether they will be in the same direction because they have their own issues of elections and everything coming up. But I think until today, I see it is in the right direction. Hope these things will get settled down and makes our life easier. Let's hope for the best. Sorry, sir, you are JDA.
Joint development.
Okay. JDA, Joint Development. Sir, can you explain the transaction a little
ID
bit?
plan. Okay. And concept space is done.
Okay. So that way, so who will be the ultimate owner of that land? The joint development agreement has lot more complications. So each scenario will have a different type of revenue. Okay. First, I will start with this. Okay. So joint development agreement has two kinds of consideration. One, generally, how does it work is they will construct 10 blocks of house. They will give 3 blocks to this party and they will take 7 blocks to the party because that may be even 5. It depends upon the agreement. So he may independently sell these things, he may independently sell these things. So that way, there is a cost which is getting involved in both these things. The control of that land will continue to be with the owners, and only at the time of registration it gets moved. But for the party who is constructing it, it will be under WIP until it is fully constructed. On the date of for the 5 units which he is going to sell, this is the cost. The entire building is the cost. For the other party who is going to sell another 5 units, the land value is the cost. So that is how it goes into their P&L. Until they both sell these to the external parties, the cost and the revenue will not come to the P&L. Both has to come at the same point of time.
And we say that it is nothing but cost is split between the two and treated as a business.
Cost, so my assumption in this case is the land is not passed down from the original owner. It is only at the time of UID registration, which is what the UDS registration, that's when it gets transferred. So until then, the cost for the party 1 will be the land cost. The cost for the party 2 is the construction cost, which will be hitting the P&L when they recognize the 5 units of the revenue. If they are not selling and if it is going to be a rental premises, they will capitalize it as a building, both these cases. Everybody clear? Or if they are forming a company, there are scenarios where they form a company and they transfer it, they will get a joint venture. So there are various structures to it, and it is all depends upon how the contract is designed. Okay.
Sir, I have a slightly different question. The construction contract, if the unit is sold during the construction, the GST will be higher rather than after you construct it, you will sell it as a unit sale. The GST will be lower.
I don't have a visibility on GST. I'm sorry, but I can talk about accounting. I don't have a visibility on GST. Sorry. So recognition and measurement criteria depends upon the type of revenue you have to recognize. You have to recognize the revenue based on the type of the service or a goods or a warranty. So it depends upon what is the nature of the service or nature of the goods which you are going to supply. That is based on which you will recognize the revenue. So what are the common features for revenue under services and what are the under sale of goods? These are all the 3. Revenue should be measured reliably, which means there should be a fair market value should be available for the goods which you are selling, and it should be reasonably priced. It should not be unreasonable, because there are 2 things which you should have. So Ind AS helps us to come to a consensus that what will be a fair market value. When there are Companies Act tells us it should be at an arm's length price. Now it is easy to push the client that every place they are saying that you have to record transaction at a fair market value. While you may have a commercial transaction, if you are bundled and given as one single contract, there will be a reduction in the price. That is a different scenario which we need to deal with it. But having said that, generally it should be at a fair market value, more or less equivalent to fair market value. So that is easy to now demonstrate, because every place, whether it is Ind AS, whether it is Companies Act, they are saying you have to account it at fair market value. So that way it is easy to push the clients towards this. So that is why we have to take the advantage of Ind AS or advantage of Companies Act, telling them please account it everything under Ind AS or fair market value or arm's length transaction. And cost about each component should be reliably measured, meaning in the first example which I gave, the services as well as the erection, I can easily know the cost of procurement. I will also have a cost of erection. How much is the employees? What will be the overhead? What are all my machineries which will get involved in erection? What is the specialized products which I have to purchase it, which I cannot charge it to the customer? There will be certain items like cranes. I may have to rent it out. So there are direct expenses in erecting that machinery in that location. There will be labor issues that if it is directly relating to that area, we need to consider all these things. So any direct cost relating to erection should be reliably measured. So these are all certain criteria which gives us clearly, yes, there are two components, there are two types of revenue involved, whether we need to split, whether we need to combine, all these things can be, see, there are a lot of judgments involved. Over a period of time, if you see, I would have said, you have to find this, you have to find this. There are a lot of judgment involved. So the clients can also use this as an opportunity to tell, this is what my judgment is. So we need to get convinced, yes, this judgment is reasonable. So that way we need to start challenging these judgments. So that's when we will be able to come to the right answer. Clear?
So how is this different from AS9?
So that's why I said that. So the performance obligation is not very clearly defined in the AS9. Okay. So there is, I will not say there is a significant change, but I won't say it is same. Okay. AS9 does not have clarity, or I won't say it as a clarity. It does not deal with exceptional scenarios. While 118 has also limitation, that's why 1115 is coming out. But yes, as in fact, if I am correct, it is almost that standard has been there for 15 years. I mean, AS9. I'm just saying. So we have envisaged the scenarios which was there 15 or 20 years back, what was there, and we have drafted that standard. Now, after that, there has been a lot more changes. While we have been updating that standard, but there is a significant change required. That's when this is coming. Now, 118 becomes irrelevant, and now we are moving towards the next standard. So that's how it is. Over a period of time, the market finds out ways to come out with a differential product. Now, e-commerce itself is a different type of industry, where you say that 10 days you can send a replacement. So you don't have the scenarios envisaged at that point of time. While we have spoken about the returns, that is not there today. This market itself is different. When is the risk and reward process? It's a question. Whether it is delivered in our house, that needs to be answered by this. So there are a lot of questions which has triggered on this transaction, which has made them to revise the standard over a period of time.
Both in AS9 and
The basic principles are same. Basic principles are same, but there has been a lot more clarity which has been given. What is a performance obligation? How it can be defined? How it can be split? When is the scenarios we have to split? How the transaction revenue has to be split between both these performance obligations? All these have got some level of clarity into this system. So this is the example. Okay. Yes, A sells a car on 13th March 2015. Okay. When I said, before going into this, I have been telling you that if there are two transactions embedded into one single contract, then both this transaction has to be split and recorded into separate transactions. This is a principle. Okay, so I will give you an example. I want answers how each of this should be recorded. Okay, scenario 1: A sells a car on 13th November 2015 for 11,000 rupees. Payment is due in 12 months. Normal credit terms is 3 months. A will not charge B any interest. Current market interest rate is 10%. Scenario. So in this case, how much I have to recognize as revenue?
Cost plus extended period credit interest.
Correct. How many of them agree to this answer? How many of them does not agree to this answer? Why?
normal rate cycle. 1 month is
let me explain this question better. Okay, normal credit terms for A is just 3 months. So he is giving an extended credit period. So there is a financing component which is getting involved automatically into this scenario. So what I have been telling you, there is a two different transactions which is embedded in one single transaction. Please split and recognize revenue. In this case, yes, you have to split this. Okay, I'll come to the answers. In the next slide, I have answers for all the scenarios. So let's discuss all 3 scenarios and go and see the answers. Okay, scenario 2. B has 2 options. One is payment on 30th November 2015, 11,000 rupees. In the same scenario, this is an extension of that. Payment due 1 year later, you pay 12,100. What will be the revenue here?
11,000 30th November 15, 1,100 in revenue.
So you are saying 11,000 will be the revenue for car sale, correct? Correct. Anybody having a different view? Who are all saying 12,100 I should recognize on sale of car? I am raising my hand. I may be also wrong. Nobody.
No, not 12,100. You have to split it and then that
So,
has to be.
no, here he has given clearly. If you are paying upfront, you pay around 11,000 rupees. If you are paying after 1 year, you pay 12,100. How many of them say 11,000?
And the first case is
11,000. Everybody clear? 11,000? Yes, it is 11,000. Correct answer is 11,000. Scenario 3, payment due on 31st December. If B pays it on 30th November 2001, then he can get 5% discount on it. So which means the 11,000, if he pays on 31st, he can pay it on 31st December. If he is paying immediately, he can take 5% discount. And A is expecting B will be paying in on 30th November 2015. What will be the revenue here? In the third scenario, what will be the revenue here? 11,000, higher than 11,000 or lower than 11,000? Lower than 11,000. How many of you say lower than 11,000? Everybody. How many of you say 11,000? You are saying 11,000?
Yeah.
Okay. You are saying 11,000. You are also saying 11,000. Okay. All 11,000 are wrong. It is lower than 11,000. So these are all the answers. Interest income in the first scenario, as you said, 10%, I will explain it, I will come to your question, okay? Interest income on the first transaction, as you said, 9 months or 12 months discount is at 10% is 1,000, so it is coming to 10,000. In scenario 2, the immediate price is 11,000, everybody said it correct. In the third scenario, it says that 5% discount if you are paying immediately, which means the current value of the car is 11,000 minus 5%. The 5% is the interest cost for a 3 years period. That's why it says less than 11,000. Sorry, your question.
No, I think that's another way to look at it. So if you go back previous slide, so I will get 5% discount. So I'm estimating, so he is expecting that we will pay before 30th November 2015 also.
That is okay. No.
The question is, what is the certainty about it? We don't know about it, right? So you are then, by stating only 10,450, you are understating your revenue.
Okay.
So which I think is also not fair. So it needs to be stated fairly. As an auditor, I will look for the past evidences, how far the customer judgment has been taken.
It's perfectly correct in Indian scenario, but what we are trying to say is, when I am ready to get only 10,450 for this car upfront, that is the revenue or a fair market value which I have assessed.
Some commercial.
Correct. I'm not saying that.
For you, I may expect, I may give 5% discount. For others, I'll give 10% discount because he's paying 2 cars for me. So it's on case-to-case basis. That's what we should.
No, it will be a case-to-case basis. But what we are trying to say is, for this period, I am charging 5% of this one, which means it becomes a financing element, not on the. See, I will put the question in a different way. Okay, is there is any change in the car which I am going to deliver, whether you make payment today or 3 months later, why is that 5% is being paid? Is the value of the car or the utilization of the car or the customer's value to that car is going to change between today and the 3 months later because he is paying a 5% differential amount? Will that change? Because
officials look at it a different way.
Sir,
They take it as
that's why I said taxes, I will not apply this. That's why I said tax people don't even understand these things because they go in a different model. So let me have the tax bit little later. But having said that, why I said this is to explain you there is no change in the benefit which the customer is going to receive. That is the crux.
I don't want to elaborate more. We'll discuss.
Okay, we will have a conversation post this session. Okay, if you have a different, but this is what the standard requires. Okay. Okay, I have a case study here. Sorry, I didn't have a printed version, so I have to read it for you. Okay, a TV manufacturer sells TV to its dealer at 10,000 rupees per TV. If the dealer takes more than 8,000 units, he will get a discount of 5%. On the year is between 1st of May to 1st of June to 31st of May. As at 31st March, the dealer has taken 5,000 units. The general past trend is he will cross 8,000 units. Now in this scenario, when I am recognizing revenue for 5,000 unit, do I need to recognize it at 10,000 or lower than 10,000? How many say lower than 10,000? Good. That is correct answer. Because when I see that he is going to get this discount, I should recognize it. I should net it off against the revenue. It is no more expense. Discount is the turnover discount is not an expense. It has to be netted off against the revenue. Okay, I'll extend this scenario in one more situation. Okay, this OEM, this car manufacturers and this car manufacturers and that or this OEM kind of a business, they will say they will identify a manufacturer and they will ask all the subcontractors to procure it from the manufacturer with the price being fixed between them, and this OEM will also control that price. He will get directly a commission from the manufacturer. From the manufacturer perspective, while he makes a sale based on this guy's instruction to his subcontractors, he also pays a commission. Is this commission is to be shown as an expense or net it off against revenue? How many say net?
Sales commission.
How many say it is it has to be shown as an expense? Why? Okay, so I will once again explain. So there is an OEM, okay? I am a manufacturer, he is an OEM, you are a subcontractor. He tells me to supply X material to you at a rate for which I have to pay him 2% commission. How much ever you consume, I have to pay 2% commission to him. Let's keep it fixed, 2% on the sales made to him, okay? So now, this 2% I will out of it 10,000 rupees sales, I will have to pay 2%, so 200 rupees I will pay. So this 200, will it be an expense or it should be a netted off against? Expense. How many say expense? How many say net off against revenue?
Fixed expense. Irrespective of sale.
Net off against revenue. Okay, sorry, how many say net off against revenue? Okay. Net off against revenue is correct because he controls the price. He says, you pay me the commission. Instead of giving a discount to this guy, I'm giving discounts to OEM because he is the person who's ultimately procuring this inventory. He procures it through his subcontractor. Ultimately, it goes to him. He controls him, he controls me, he controls the price, he does everything, and for which he is getting the 2%. So in my cost, when I'm handling this revenue, I would have considered what this 2% which I'm going to pay, which is more of a turnover discount, which I'm going to pay to this guy. So this has to be netted off against revenue. So this may look very, I mean, if we see these two different transactions, the answer is correct. What you said is correct, but we have to mix and see link both these transactions. That is where this one comes. It is more of a discount. It is not a commission. While it may look like a commission, but it is a discount technically. Clear? Yes, sir.
Dealer commission stand on the same footing.
Dealer commission, he is procuring from me and he is getting the commission. Yes, because it is.
For example, is a Maruti dealer.
Correct. Yes, Maruti pays to his dealers. Maruti has to net it off against the revenue. Because dealer commission, the same example, 8,000 in TV sets. Any other questions?
I think it's a quality. Sales to dealer itself considered as revenue, isn't it?
Correct. Sales to dealer is considered as revenue. Any discounts to him or any commission paid to him is obviously seen as a discount. But there I will tell you one more scenario. There are employees who sits in Maruti. That is a different thing. This will be an employee cost. But this is not paid to the dealer. This is paid to the employees. There are scenarios which there are transactions which can come out of this also. Paid to the dealer? Yes. I have a slide for you. So these are all the things which I wanted to discuss. Recognition of target incentive, bulk discount extended to the customer. If your customer and if you are extending some of this bulk discount to your customers, it is net of revenue. This is where we didn't have a clarity under our current accounting standards. I mean, your question was, where is the change? There is no clarity in the current accounting standards. We have been applying what is logical, what is correct as per our professional judgment. Now there has been a guidance which says that no, you have to work like this. And this has an obligation to on our clients to follow this. So that way it is easy for us to convince them. Okay. Okay, recognition. I think the second point I have already covered. Upfront fee on stage of completion. Okay, I'll give you a scenario. Okay. Suppose there is a car manufacturer. He sells a car through his dealer to a customer. He gets an extended warranty. Extended warranty, additional income called extended warranty. Okay, so how this extended warranty has to be recorded in the Ind AS scenario. So I'll tell you the scenario once again. There is a car manufacturer, he sells it to the dealer, dealer sells it to the ultimate customer with the warranty on the manufacturer. It is not, no more obligation on the dealer, it is a warranty on the manufacturer. There are 2 years of basic warranty, there is a 2 years of extended warranty. This is the scenario. For extended warranty, I have got a separate consideration. How is this going to get accounted? So first let me ask you, how many performance obligations are there? One? How many say one? How many? Only one. How many say two? How many say two? How many say three? What are the three?
Sale of car, normal, extended.
Okay. Okay, interesting perspective. How many say four? Okay. If a normal warranty is given universally, it is not seen as a separate performance obligation. Well, your three answer is correct. I will tell you what are the three components. Okay. First component, sale of car, performance obligation. extended warranty is a performance obligation. Extended warranty starts after 2 years. So there is an interest component in that. So there is a 3 components which has to be recognized separately. Clear? Everybody clear? Not clear? Correct. Exactly. Precisely. So there are 3 components. One, today I sell the car. That is one transaction. Second, I have an extended warranty. Say the extended warranty value is 10,000 today. It may not be 10,000. You go and ask him 1 year after, he will raise the money. 2 years after, he will say different money. But after warranty period, he will not take it extended warranty. So what is that differential rate? Is the finance component for the 2 years. The third is the extended warranty. So all this fair value has to be considered, and your consideration has to be split on this basis. So you will have 3 revenue streams from this one single transaction. This is the example of how a simple sale of car is getting into a complex Ind AS revenue recognition.
But now, the sale of car itself, one is delivery of product, the other thing is warranty for 2 years. This revenue I can recognize upfront, or it has to be...
I'll come to the revenue recognition. First, let's understand what are all the 3 things which we need to recognize. Okay? When do I recognize the warranty revenue? It is only at the time of performing the performance obligation. That is, I have to defer it to after 2 years. During this 2 years, I will get the interest income, and from 3rd year, I will amortize this over the warranty period. Because during this period, any expenses comes, I have to replace them free of cost. For which the revenue is there as a warranty income.
No, this is extended warranty.
This is extended warranty. Normal warranty goes with, so normal warranty, if that is an industry practice, then it need not be considered as a separate performance obligation. Upfront you can take it.
What is the logic?
The logic is, in 2 years period, nothing will happen to that car. There will not be any damage. That's why it is called warranty. It is very, very exception. How many cases a car has given an issue on engine or something like that in 2 years? Right?
No, these days it's happening. A lot of cars are calling back.
That is a specific error, for which it is a specific activity or a specific identification of an item. So that is an event which has happened subsequently. That is a different scenario. And that will not be there for all cars. That is for all cars. Here it will not be for all cars. One, and maximum in a 5 years period it may be one. So this is where the thing. If it is an industry practice and if it is a normal trade, then it need not be considered, because anybody just wanted to promote their products, it is given as general thing. But for extended warranty, you don't get it. You have to pay some money. In 115, this normal warranty will also has to be seen as a separate performance obligation that has to be dealt with it separately. Now I am not getting into that. So your answer is partially correct, but current standards does not want us to split that.
But the fee service is different.
Fee service is different. Any questions as of now? Any doubts on that example? Because if you are not understanding that example, you will not appreciate every aspect of revenue recognition. And that's why I took that as an example. That is a little complicated, but I just wanted to explain it in detail. Clear? Super. I will give you one more example. Okay. Now I have constructed a okay. So I'm a flat promoter. Okay. I have constructed a flats, and I've got 50% of the or 100% of the flats has been sold. It has been registered with the customers. Registration is complete. Everything is done. But I still have to do painting or some alteration work, some completion related work. When do I recognize revenue under Ind AS scenario? On the time of, so I'll give you three options. One, once I get the money, A. B, when I register the property in the customer's name. 3, when I hand over the property in the customer's name.
Hand over to.
How many of them say C as an option? B, registration. A, nobody. Good. Everybody is correct on A is a wrong answer. B is also a wrong answer. Technically, it is just the ownership change for that. The control does not move to the ultimate customer. Only when the control moves to the other party, that is the handing over happen, that's when you can recognize it.
If there is a damage to the property in the meantime, so
He has to make good of that. He has to, because you have not even handed over.
because you have registered it,
Registration. Okay. Legal registration is more of a formality. Generally, legal registration and handover will not have a significant timing difference. But if there is a timing difference, then yes, it will be happening only in the year in which it is handed over.
so insurance company will still pay the damages to the
Builder.
It depends whether they have taken insurance. Nobody takes the insurance. They will reconstruct and give it to you. Okay. So clear now? No, I'm just flipping the slides because giving that example and trying to explain you the concept which is there in the slide. If you want me to read the slides, I'm happy to do that. But I don't want to read it just blindly there. Okay. Any other questions? I mean, whenever you have questions, please stop me and ask so that it becomes more interactive.
For example, in my case, you have two different agreement, one for the sale of land, UDS transfer agreement, the other agreement is for construction. So as you said, there are structuring, there are one more company which owns land and the other company which constructs. So the registration happens when some 30% of the consideration is given. So the land title comes to the buyer's name. So the construction balance 70% is there and there is a timing difference also. Minimum there is a year gap. So when, how this revenue, how it can be recognized?
Revenue. So I will ask you one simple question. Who will control that land post registration?
Builder.
That answers the question. So till the control moves on to the other party, you cannot recognize revenue.
The entire building.
I'll come to it maybe at the least.
That's when the unit of sale, right? Percentage
Yes.
of completion, then we can.
Percentage of completion, then he controls the entire thing. He just instructs me to do this, do that, do that.
Yeah.
So while I may work on his land, he controls what I have to do. So that way it is his control.
Yeah.
I don't control it. Okay? Sir, you had a
Yeah, see for example, this property I have 10 plants. 8 I handed over. 2 I have not handed over. So I had to recognize only for the 8 plants. Other 2 I should not
It
recognize.
will be in your WIP till the date you sell that to a third party and hand over that to the third party. It will be in your books as WIP. So for WIP evaluation,
Until control is
moved on to the other party
it will be still be in my.
in your books. That WIP will be, we have an obligation to check whether the WIP is reasonably stated, whether that requires any impairment. If the market prices of this comes down, you will compare this with your WIP value. If your net realizable value comes down, this is part of inventory standard. This has nothing to do with revenue. So it is part of your WIP. Then you need to check on every reporting date whether the WIP is appropriately stated in the balance sheet. That is based on inventory standards. I'm not touching that, but I just told you as
If
part
there
of
is a dispute is arising, the buyers is not taking because various issues in this particular plan. till that the dispute settles.
Dispute scenarios needs to be evaluated separately. Let me put it this way. So the company has taken adequate steps to hand it over, and it has done the registration. It has got the full registration, and it has written at least legally to state that you can take a delivery, but for some reason the customer is not willing to take. Technically, I have completed my obligation, and I can tell in legal terms, in legal ownership is already moved. I have also written a formal letter stating you please take over this, and I am also giving that to you. So I am ready to give. You are not taking, that is your issue. You are paid, so nobody will be in that scenario. Even assuming he is there, then I can recognize the revenue. Considering I prove that there is nothing pending from my end and there is a default from the other party. So that is an exceptional scenario. You need to evaluate why he is not taking also. If there is any dispute, then do we need to have any provisions there? That is something which we need to deal with it separately. We need to understand better what is the dispute. Yeah.
So in case of
Hey, call me please. Okay. Yeah.
the railway contractors, normally for any contract, they normally take 5 to 6 years. So as per the contract, normally after 50 or 30% of they get some money, after 50% they get some money. So how will you recognize that?
Generally railway contracts, the railway tells you do this in this job. So it becomes more of a subcontract work, which means I will recognize over the POC method. So when I am entering into a contract, I will know what will be the cost which I will be incurring in completing this, what is the expected revenue. So I will recognize based on the percentage of completion or based on how much of the cost which I am incurring. Someone had a
That we have a process non-completion certificate and completion certificate.
Everything will be there. People may not take the delivery.
Completion certificate is important or possession?
No, that's why I said all paper documents is fine. Physically, it has to be given, the control has to be moved on to the customer. I should not have a including, even if I'm doing a painting work, nobody can live in this house. I mean, I'm just giving you an example. Okay, if I hand it over and there is a mistake, then I'm doing, that is a different scenario. But generally, it is given to the customers, and once he enters, that is the way we do. There is one more scenario which is coming up. In this real estates, now there has been 2 years maintenance free, 3 years maintenance free, 5 years maintenance free. These attractive things are coming up. Will this be a separate performance obligation?
Yes,
Yes. How many say yes? How many say no? How many say no? Yes, no? Maybe? Okay. Here it is yes is correct answer. I will tell you why. This is not an industry practice. This is to attract the customers. They give an extended period which is being considered as part of their own pricing in the house. So there is a 2 performance obligation is there, and this has been factored in the price. Nobody gives nothing. No one gives nothing free of cost. So let's be realistic. He takes every money into consideration in the entire pricing of the house. So that way it is 2 different performance obligation, but the price is including this 2. Clear? So there is, you need to split this into 2, and you have to have this obligation or this revenue postponed to the period in which I am doing that service or the construction person doing that service.
How to fair value this?
So there is always so anybody who is taking these scenarios, he will know what will be the cost. The company is the best person to analyze this cost. So they will have a cost of maintaining it over 1 year, maintaining it over 2 years. So there will be a percentage what they will be fixing it, and or after 2 years they have to charge something. That is also one of the things. That is also now fixed. So everything will get fixed. So based on that, you have to take a cue and see what is the fair value. You cannot have a right to fair value for this because this is not easily. I mean, it changes from flat to flat. I mean, in one set of group, in the next door it will be 1,250. Here it will be 2,000. I mean, the difference is there. So it depends. So you cannot have a fair value, but based on the cost, you have to estimate what will be the fair value.
I have questions on insurance brokers.
No, sorry, just one more thing. While you have the cost, you will have the profit margin on the entire flat. So because this is a POC method, this cost is able to be incurred. So you can split it based on that cost. I haven't come across this scenario, so I just thought when I was just discussing.
Correct, but this will be a unit of sale method.
Correct, correct. See, simple. I would have had 30% margin. Okay. Whatever is my cost, I would have had 30% margin. Same cost is I have estimated for next 2 years. The 30% has to be posted. So basically, the cost into 30% is the fair market value. That is one way of identifying. I'm just saying. But there are multiple ways, obviously.
I have a question on insurance brokers.
Let me try to answer. I have not dealt with this scenario.
See how the revenues are recognized by insurance brokers. They get a commission on each and every insurance contract where the sale happening to them. Okay, for the insurance companies are brokers are clients are insurance brokers taking commission from insurance companies based on that. Everybody is here. So, insurance brokers. Hello. Insurance brokers, I just would like to have a question regarding insurance brokers. How are the revenues are recognized, their commission to an insurance company as simple as that? Is it, there are two ways. Is it based on the work, once the identify the customer, once they sell the policy to the customers and they buy policy from insurance company, sell it to customer, their work is over. So substantially their job is done, so they can recognize revenue one way. Or else, based on the insurance contract, maybe the policy get cancelled with the midway. So there will be reversal of commission as well from insurance company. So how will you recognize the revenue for insurance brokers?
Okay. So, good question. So I just repeated for everybody's benefit. So this question is, there is a commission which is being paid for the insurance which has been taken. He says if the insurance gets cancelled in between the period, he has to refund the commission. Okay. First, if that refund clause is there, then you have to postpone the revenue over the period of the insurance. But my understanding is, it is for identifying the customers, and once the commission is given, they don't get the refund. In that case, it is for the identification of the customers, and the insurance agent will not have any obligation either to the insurance company nor to the customers for doing any performance obligation after that. My performance obligation to the insurance company is, I identified the customer to you, you sold the policy to him, you pay me the commission. So my performance obligation is identification of customers, not that he has to be servicing the entire period of the day. I will tell you the example in other way. Okay, in mutual fund, the commission from the AMCs are paid upfront, and it has a clause which says that you have to refund if the customer goes out within a period of 3 years. I mean, it depends upon when he moves out, that time yes, you need to postpone your revenue until India is.
It's not agent. He's a broker.
He's a broker.
The clients are with the brokers. You know, see, if I am a client, you are a broker, I am coming to you, and you are evaluating my risk, and you are choosing insurance company and products, and you are buying insurance company product and selling it to the customer. And throughout the period I am servicing, even if there is a client comes, any claims on that property or something, so I'm still servicing as a broker. So that is a continuous service is there.
No, continuous service is to maintain that relationship. That is a different thing. So I wanted to see whether I can have any other business with you. That is a relationship which I'm handling. But what is the performance obligation? What for I receive the commission? The relationship is different. What for I receive the commission? Is it for identifying you for that insurance company or for the entire period of the insurance company? What is my obligation during the entire insurance period? If I have an obligation and if I am not doing that, then yes, I have to postpone. If I don't have any obligation, it is a contract between the insurance company and the customer, and I am just bridging the gap and I get a commission, then you are not required to. Because it is commission once paid, you will not refund. In insurance, I don't think there is a refund clause available. But yes, I agree it is in mutual funds there is a clause. Current Indian GAAP says it is like a warranty that this guy will stick to you for 3 years. So there is a warranty route which is being taken by most of the mutual fund brokers. But I don't think it will be a scenario in India. I haven't evaluated this scenario in 10 days.
Sir, I think the way in which the total commission payable to insurance agents or brokers is totally different. When you look at the policies, you have to split between life policies and non-life. So first non-life I will tell. Non-life is always 1 year period. So they get the commission. So there is no question of running repetition, postponing another thing. Even if
there also it is possible if it is split over the 2 financial years. Because I would have taken a policy in first December, I would have received the commission in the December month itself, but only 4 months is there in the current year. But there is an obligation to refund that commission?
So generally it is not there.
Then you can recognize, because what the performance obligation in that scenario is, for insurance company, I am identifying the customer. That is
Once the premium is collected, the agent is
done. That's it.
When coming to life insurance, to my knowledge, what is current practice, I don't know. Generally, the life insurance companies pay the commission in 2 different methods in returns. For the first year, subsequent year.
Correct.
I don't think refund comes into play.
Correct. There also, what I am saying is, first year there is an increased percentage. Yeah. Second year onwards there is a lower percentage. Increased percentage is for 2 components. One is identifying the customer, and second one for the insurance premium paid. Yes, I will recognize that income upfront. Second year, if he pays automatically, whether it is through you or he is directly paying it, you will get a 5% or whatever is the percentage. So then it is on the date on which the second premium is due, and once he deposits that amount, and once it appears in your statement that you will get that commission, you can recognize it upfront. There is no doubt, because there that obligation overs. I don't have any other obligation relating to this in that year towards my customer nor with my insurance company. Once I'm done with my obligation.
What I'm trying to impress, it is not so
It is not very complicated, but it's just, he was saying that refund. That is where I said there is a complication involved.
One clause is the looking period of 30 days. Looking period, like in 30 days, if some customer wants to refund the policy, don't want to accept the loan, he can return the policy. And as sir told, once the premium is paid by the customer, agent will get the money. Right?
So
Like
that-
I sold the insurance policy on 15th March. That looking period is going on complete on 15th April. And on 5th April, customer is going to return the policy.
I agree, but it is like any other product sale which will come as a return. But generally the return is not very encouraged in this insurance policy. Okay, you should also consider the trend and other things. But I don't think so. Once I don't foresee that as a significant event which will happen, my performance obligation, whatever I've been paid is done and it is complete. Then yes, I can raise it. Okay. Any other questions?
The company is doing a customization job, service industry.
So how is this different from the company creating an application? Will the revenue recognition concept be different?
Customization meaning?
For example, they are providing customization for SAP. SAP implementation, they are doing this one. Now the SAP is owned by the end user, customer.
And he gives me an instruction of the customization.
Okay. Now, another company is trying to develop an application. They have the customer product and service. So how will the revenue recognition work?
First, on the application front, is it designed by the company based on the instruction from the customer, or is it developing a customer for a is the company developing a soft application for a larger customer base, and I have not identified the customers yet. Okay, for example, I will tell you, I am developing a software for an insurance sector. Okay, it need not be specific for any insurance, it may be for all insurance products. So then it is my own product which I am developing, like a construction of a flat which I will deliver it for various customers. So that is one scenario. If I am doing based on the instruction from a person, then I become a subcontractor. So I will evaluate what will be my cost. How will I given in the code? I would have evaluated what will be my cost. What is the expected? What are all the admin charges? I would have said this is I consider margin. I would have given him a price. So then it becomes a POC method. So the difference is you just relate it to in such a way that how is this transaction designed? You get into the mindset how this can be segregated. What is the performance obligation? We should just blindly question the client as well as us. What is the performance obligation? What is the benefit which the client is seeing? What is the benefit which your customer is seeing? If you question all these things, see, it is more towards, it is not about numbers. It is about understanding the business and understanding how these guys are actually seeing this in this one. Not only from the company's perspective, how his customers see this value. It is the entire transaction, entire commercial transaction you have to see. So you have substantial mobilization advance. Okay. So for a project construction, if so advance will get covered under financial instruments. Okay. There is a
Point is, I have incurred most of it.
No. Okay. You have incurred most of the cost. Okay. So you would have recognized revenue. Correct. Under POC method, whatever I have incurred cost, to that extent, whatever is my percentage of margin, I would have recognized revenue. So one is done. Whether
What is the point is, I determine the POC also. To that extent, I recognize that is enough or
to the extent of POC, you can recognize revenue. Whether in
that hasn't covered the full portion of the advance.
So it need not be covered. So that is what next coming. In balance sheet level, I would have recognized POC, got a trade receivables. I would have billed in a totally a different way. I would have got a advance. Running bill. So billing would have been in different scenario. Recognition of revenue would be in different scenario. Advance, I would have got it upfront. Okay. Who has a right to net off this advance vis-a-vis my trade receivables?
Scenarios. One you are allowed to do the running bill, another only at the end of the year.
Correct. So, if it is explicitly said in that contract, then you can net it off as per the contract in balance sheet. If it says you have to net it off in the year end, you have to have this until that year end comes. This is primarily goes based on the balance sheet netting off. It has nothing to do with the revenue recognition. Revenue will go as per the POC method. But only thing which we need to be very, very clear about is, I should not have a liability that is unrecognized, unrealized revenue. I should not also have a debtors, which is more conflicting for the same contract. There you should see, why am I having both these things? It should not be possible. No, unbilled revenue and
Will it be treated as money received with the zero rated standard?
No, you cannot net it off. If your question is
What I'm saying is, suppose it's a 3-year contract, and receiving in advance of day one mobilization of a substantial portion, with a condition that it should be additional at the end of the year, will it be treated as money received interest, non-interest value? That's the question of discounting. That's my question.
Okay, your question
I'm
is.
very different.
No, it is dealt with it in a financial instrument. I will give you an answer.
We'll have it, sir.
Okay, no problem. I will have it separately because it has nothing to do with the
I'll send
revenue.
it.
Yeah. Okay.
I don't know how to base that in.
So these are all we have spoken. So you have any
One more
questions?
question.
Yeah.
What about the idle time billing? I specific missionary. I have allocated to a particular project. He has not provided me a design or something else. Missionary is remaining idle. There is a provision in the contract for me to bill the idle time. I bill it. Can it be treated in the period in which I bill it?
Yes.
I have a right.
Yes. Because it is for that period. It is for that period you would have cost that depreciation in your P&L. You are eligible to receive a revenue. You receive that revenue. This is exactly precise. While I may take a wrong example, but all these electricity companies PPA says that whether PNEB takes electricity or not, they will pay a fixed amount to compensate them in this scenario. But as a PPA, I will deal with it in a different scenario. But there is an example which is there where they are eligible to realize the revenue. But PPA as an example, I will deal with it in a separate way. I think it is covered in the last slide, sir. So, right to return, if there is an uncertainty about return exists, recognize when the shipment is formally accepted and goods are delivered. Period of rejection is lapsed if that return is very, very significant. In the insurance contract, in our example, that is very, very remote and that has never happened. So in that scenario, that's why I said it is okay. So there are a lot of judgments. While these are principles, there are a lot of judgments involved in recognizing revenue. These judgments has to be challenged. This is what I keep saying. Judgments. If you say a judgment, you may have a view, I may have a view, the third person may have a totally a different view. So we need to challenge and come to a consensus which is right. That is, I may be also wrong, you may be also wrong, the third person may be correct. So we have to go to a consensus which is appropriate for that scenario. So reading of contract is very relevant, understanding the commercial behind that contract is very relevant, how the customer sees the transaction is relevant, how the company sees the transaction is relevant. So you have to consider all this viewpoint and come to a judgment, consensus that when to recognize revenue. It is not very, very easy to, I mean, whether these conditions are considered in the erstwhile gap, it is yes to some extent, but not so explicit guidance has been given in the current standards. That's where this becomes very, very relevant. Okay, let me go to some other examples. Upfront fee we have discussed. Any doubts on upfront fee? I have covered upfront fee, right? The third case study is okay. So I wanted to touch upon this excise duty and the GST. So this year has been first 3 months there is an excise duty and the next 9 months we have GST. So is the turnover includes excise duty? Yes. How many of them say yes? How many of them say no? Okay. So next question. Is the turnover includes GST? How many of them say yes? Nobody says yes. Super. How many of them say no? Super. Okay. The second part of the answer is correct. I'll tell you what is the difference between excise duty and GST. Excise duty under Ind AS it is part of the turnover. I'll tell you why. The excise duty levy is on at the time of manufacturing. So it is not on account of trigger of sales, it is on account of manufacturing. And so once I manufacture, I have an obligation to pay it to the government. While the government may collect it for logistically at the time of sales, but it is a triggering event has happened at the time of manufacturing, so it has become my cost already before even I identify my customer. So once I identify my customer, I have to obviously get this amount from him. So I also charge it separately as an excise duty. So it is on convenience per se, it is on sales. Being collection is, collection by the government is made based on the sales, but it is a triggering event on a manufacturing of that good. So excise duty has become a cost at the time of manufacturing that goods. That's why it becomes a cost as well as it becomes a revenue. Okay? Why then GST has a different treatment? GST is a consumption-based tax, which means the triggering event is at the time when the consumer is consuming it, or when I sell the goods to the consumer. I don't get the benefit. I am just an agent, or I am just a transporter to collect the money from the customer and to pay it to the banker. To pay it to the government. So that way I don't have any economic benefit out of this GST. So that way GST will not form part of the turnover, while excise duty will form part of the turnover. Everybody clear why there is this? So any taxes, you should see whether what is the triggering event, whether who has an obligation. Am I just doing a transporter job of collecting it from the customer and paying it to the government? So once we answer all these questions, whether it will be part of turnover or not, we will decide. Clear? Any other questions on this? I will exactly take another 15-20 minutes. Is everything, is that okay with you? Yeah. Okay. So here I have already touched upon the interest piece when we were explaining on the financial services. Anybody having any other doubts on interest? How interest has to be? This is what is called the effective interest rate method. When we
now the MCLR concept is there, and bank reduce MCLR in between, and interest rate will sometimes reduce, sometimes increase. Based on that, the effective rate of interest will also change. So in that case, how they will
see effective interest rate will change. I agree. It will be very, very marginal. Every time effective interest rate change, you need to recompute your effective interest rate method. It is slightly complicated, but yes, we have to do it.
Like for previous period also have to do for the rest of the cost?
It is only from the date that event has happened. It is only prospective, because you don't know on that date. You cannot go back and you didn't do any mistake. You were on that date, that was the revenue. And there will not be any significant change between what you have been recognizing and what you are going to do.
In banking industry, every time interest rate increased.
Yes, that is an issue. You can't help it. And my sense is the banking industry changes only to the new customers. While now RBI has come out explicitly, but till today it was only a correction in 2 years time or 3 years time. They don't generally change that interest rate. So that way, yes, they have to do it prospectively on the date, on that event which is happening, to reduce that interest rate. Any other questions on interest?
The flat case, apartment sales case, if they are buying by giving full cash at the time of initial stage before the construction itself is over, the rate will be something. If it is progress payments, then the rate will be different. So this has to be treated as
interest component.
Interest component. In the second case, from company,
because there is an explicit interest component, right?
Second thing is advance pattern will be different and revenue recognition will be
Sorry,
different.
when I said interest is an easier method, there are two components to it. Okay, there is a genuine increase in the rates of real estate during the construction period. While it is not happening in the last 2 years, if you go back some 5 years back, there were genuine increase in the real estate. You need to differentiate between the change in the real estate estate prices because of which the price is increasing, or it is purely an interest cost because of upfront money. If both these amounts come to a same point, then it is the same fair value.
Normal inflation, if it is
Normal
5%,
inflation, then yes. If it is a normal interest rate, at that point of time when I am giving advance, it is 10%. I can recognize 10% as interest. Not the entire increase of real estate prices. See, there will be differentiation of that. Correct? Today it will be 2,100 rupees square foot in this area. Tomorrow it may not be 2,000, it may be 4,000. So that is not the interest cost. That is where the differentiation has to come.
So the second question is, the collection will be milestone based and the revenue will be percentage of completion based. That be the case, there will be some advance received from customer which will be laying in our liability. So it is not cash settled or equity settled. So it will not be.
No. See, there are three. That's why I explained. There are three things which will be there. Advance one will be running on different basis.
Correct.
Invoicing will be on a different basis. Third one is POC, the actual revenue. POC, whether it is positive or negative, depends. It may go to unbilled or unearned revenue. Okay. Receivable invoicing vis-a-vis advances will get knocked off based on the contract terms. There will be something which will be adjusted only in the end, and the balance you will be receiving it on the basis of receivables.
So this advance I can show as a liability if I have collected more, otherwise it will be as a receivable. There
Correct.
will not be any fair valuation or nothing on advances.
Nothing on that. So it is due based on that. You have to evaluate the fair value on the date when the contract is entered. If you believe that there is an interest component, on that day itself you should evaluate. While if there are changes subsequently, then you have to evaluate whenever the change is coming in. Suppose I tell them, suddenly I give a scheme, you pay everything today, I will give you a 5%, 10% discount. That is a change which has happened. That is an offer which is given that day. So then there is an interest component. So that is different. So there are these are all the scenarios which was not envisaged in the erstwhile India. So there are a lot more clarity which has come in by days. So this is where the difference is. There is nothing conceptually. What is that? You have sold revenue. You have sold the control. You have given that legal obligation to them. Yes, that is right. There is to some extent netting of clarity has come in. So nothing great has changed. Conceptually, we all know when to recognize revenue. Just go to the basics. Think independently whether there is a ownership has changed, whether there is a this one. If that is satisfied, then you can recognize it.
Previously, we have our existing standard, not in India scenario. We have revenue recognition, construction contract, and there is a guidance note on real estate transfer.
Correct.
In this India
This
scenario,
India is everything deals in this.
these two standards.
These two standards. And going forward, it is only one standard, 115.
115.
Huh? It is from today it has been notified. And okay, there is one more thing which we have to be very, very cognizant of is for year ended 31st March 2018, we have to give disclosures under 115. What will be the impact? If they are following Ind AS, we have to give a disclosures under 115. What will be the impact on 31st March 2018? Because that is going to be the go forward basis. While you may not adopt it, but you may have to give a disclosures to that effect. So it is not only about transitioning the current year one, you should also consider what will be the future. So more from the transparency perspective, this is a requirement.
That is a small short.
This is-
That is a small year and already we have to
check on 5%.
No. Your accounting policies and recognition and measurement criteria will be based on the current standards. But as part of disclosures under Ind AS 101, what it says is it requires us to give if there is going to be a change in policy, you have to give a disclosure today what will be the impact.
Or impact analysis.
Impact analysis. So, how many of you faced, so next point which I wanted to go is on cutoff, okay? How many of you faced issues with cutoff in clients? Everybody should have faced this issue. Cut-off is becoming really an issue. I mean, let's be realistic. Everybody is pushing their sales only in the mountains. So that way, we need to know when to stop, when to recognize revenue. While on go-forward basis, we may have some clarity because of e-way bill, because they cannot say two different positions with respect to two different. For government, I will say this is the sales, last sales. For auditors, they cannot give us a difference. So that is, in a way, it will help us to address once e-way bills gets implemented properly, not like GST, because GST had its own issues in the initial period, but once it gets implemented properly, we may have some level of solutions there. But considering the cutoff, it clearly says when to recognize revenue. Mere identification of an inventory for a customer will not make sales. He has to take the risk and reward, has to pass us on to him. If there is any loss, it should be on the other party. I may take. So how will we come out of this scenario? There are scenarios, there are companies which are evaluating that I will deliver it to you in my factory premises. If I am taking a freight or insurance, I will be taking on behalf of you, which I will be charging it separately in the invoice, which means I am acting on behalf of you as an agent. So that is a separate transaction, this is a separate transaction. So the revenue can be recognized once I send out of my gates. And the insurance and the freight will be taken on behalf of the other party. So that way it becomes an agent relationship. So in a same transaction, I have two relationships. One is sale of goods as a manufacturer. Second, I will take it as an agent relation. So that way, yes, this is also one of the scenarios. So you need to consider why each of these things. There are thought processes which has gone behind each of this transaction, each of this performance application. In this case, there are two performance applications. One, I have to deliver the goods. Second, I have to take insurance on behalf of you. That is the second obligation. But suppose, if the contract very clearly says, you do whatever you want to, you have to deliver it in my factory sales, then you are gone. You have to ensure that it reaches this, only then you recognize the revenue.
Even if it's X-Works contract?
X-Works contracts I am saying, you have an obligation that you have to deliver it in his factory, which is what the X-Works is, right?
Who are destination is placed. And again, you take the X-Works in my factory.
So X-Works you are saying in my factory, then it is a different scenario. That is not a scenario where we are talking. If you have an obligation to deliver it in his factory, like what Flipkart says. Flipkart says it will be delivered in your house. Then his performance obligation completes only if he delivers in your house. Until then, it is his responsibility. Anything which gets damaged on the way, you don't take the ownership, you give it back to them. So which means that he is taking that ownership, he is taking the insurance, which means he can recognize revenue only if it reaches my house. Clear? Clear? Okay. So, royalties. There are multiple ways of royalty being seen. So another 15 minutes, sorry. Okay. So royalty is, there are two types of royalty. One is for the technology and second one is for the sales which you make here. Okay. If it is for the technology, whatever I sell, and I should evaluate when is this technology comes into this. When can I recognize that technology? What is that I am transferring to the other party? So, if it is for the technology and I transfer the technology immediately and whatever he does, it is irrespective of that I get a fixed amount, then I can recognize that royalty upfront. If there is an obligation that you will give me the royalty, you will give me the technology, I will pay you upfront of 5 crores, but I should sell at least 5 lakh units in the current market. If I am not selling, you should refund some portion of it, then you have to evaluate whether the entire 5 crore can be recognized upfront. So there will be a computation how I have to refund. So based on that, you should also defer the revenue. So it is based on how your income contract is designed. If it is upfront, it may be look upfront, but there is a technically I have to refund this royalty if he is not selling the 500 lakhs or 500,000 units in the local market. So that is one type of royalty. If it is based on the number of units, it's a straightforward case. Whenever he sells, I am eligible to receive. So it's a straightforward case. Whenever he says I am eligible to receive, I can recognize revenue. The payment terms can be different. Recognition is based on the underlying utilization of technology or the sales. There will be a computation given in the contract. That is where you have to understand what is for. Generally, if they are paying a upfront fee and there will be a clause like this, there will be a commercial term under which these guys have agreed these things. There will be a logic behind this refund amount. So you should understand that logic. So it does not stop with this agreement. This agreement does not have an entire computation. We may go back to the business, you may have to go back to the management, because these are all the things which are dealt with the management. You need to understand what is the commercial transaction behind this refund.
Utilities for a period of 3 years. Then how do we split the revenue?
So 3 years.
And after 3 years, and the 5 lakh units have to be done over a period of 3 years.
Okay.
Then if you are a time basis or a limit basis.
No. See, one portion generally, okay, our past experience is not that the entire 5 lakhs will be refunded. So it will be, say, 1 crore will be based on the units, balance, or 2 crores will be based on the units, and 3 crores will be upfront. So if they have identified 2 crores over a period of 5 lakhs units, today for the first year, suppose I have crossed 3 lakhs units. 3 lakhs is around 60-65% of so I can recognize 65% of 2 crores. In the next year I am selling only 1 crore, 1 lakh, and then I can recognize it is 20% of that. Suppose in third year I am not selling, I have to refund it, I have to have it there. So I will end up having what will be my...
Why they go by the substance of the
Correct. Any other questions on royalty? Dividend, it is very simple. There is no change between Indian GAAP and this one. Whenever you have an right to receive, you can recognize the revenue. The only change between dividend, you want?
Sorry.
No problem. So between dividend recognition, income side there is no change, but whenever you have to make a provision, it is in the period in which it is approved by the shareholders, you have to recognize that in the provision bit. I mean, it is from the declaring dividend. I am just touching upon the other side also. Any doubts until now? Okay. So there is this customer loyalty program. So you go to for example, you go to supermarkets. Now even the supermarkets has this customer loyalty program. So you purchase for 10,000 rupees, you get 1,000 rupees, 1,000 points added to your account, which is 10% of your this one. Each point is 1 rupee. So there is over a period of 1 year, you are expected to generate units of around say around 10,000 units. So you can purchase for any item which are less around 10,000 rupees. So what should be the revenue which I should recognize on the date of sale of goods? I'll repeat the example. 1,000 rupees is the 10,000 rupees is the sales which has been happening on the day 1. So he says every rupee you purchase, I will give you 10% of the value of the purchase as units to you, which you can redeem it at the end of 12th month. So today I made a sales of 10,000 rupees. Okay, do I need to recognize 10,000 or lower than 10,000? Why? Because there is a value to the reward points which so So answer is correct. Yes, you have to recognize lower than 10,000. Okay. Now I am giving you one more twist. The trend of the company says that only 80% of the units are getting redeemed. So in that scenario, so now 10,000 rupees, 10%, 1,000 rupees. Do I need to recognize 9,000 or 1,000 into 80%, which is 800? 9,200. Do I need to recognize revenue of 9,200 or 9,000? 9,200. Raise your hands. 9,000. Nobody says 9,000. Super. Correct answer is 9,200. When I am giving a reward points, even though it has a right to the other party, I have an estimate based on the past trend, which I will be able to give as a discount. So this is perfect answer. Everybody understood the concept of revenue under Ind AS?
Yes.
Any doubts until now?
I have a question. This is same like airlines loyalty also. Airlines loyalty only will reach only certain point up to 40,000. Then only you can what do you call
Redeem it.
redeem it. All else you
It gets lapsed.
It gets lapsed. Then what is the that case?
So that is also goes based on the trend. So that's where I said that there is a minimum point. So if that minimum points in the past, you will have a trend. Not everybody will cross that minimum point. So there is only 50% of the people is crossing that point. You will recognize revenue. Suppose for every 5,000 rupees or every mile, you will come. What will be the discount estimated based on the past trend? That will be the revenue which postponed for these miles. So it is the same concept. I took a simple example. There is slight complication in this, but yes, the same concept, the computation is same, just that you have to put miles into the condition. It may be a complicated computation, but the concept is. Any other questions? Did I see that example? Award credits, this is what we discussed. Initial sale and award credits, you have to bifurcate your revenue, you have to postpone that. So same concept, we have put it in this one. So this is how you split, we said it in a simplistic way. There is an example to this. Okay, so this is on the commissions which we discussed. How the commission has to be recognized, whether it is upfront or you need to charge it off. This is where this is being explained. So when it is, so there is one more concept which I wanted to explain is there is a principal and agent relationship. So whether it is a gross or net, I explained you one with respect to that revenue. There is an insurance and the freight is being, I am taking it as an agent. In that case, if I am an agent, I should net it off. Net revenue. I cannot take two different positions for two different things because I am eligible only for commission in case of an agent. I don't own that obligation. So that way, there is when you take this kind of a position, your turnover will come down because you are netting off your cost with that. While you may make marginal profits, you have to net it off that. So that way, while it may look favorable for the company, there is something which also follows it, like bringing down your revenue to this extent. Agent's principle, the same concepts which we have explained here. Okay, there is this barter system is there. Okay, so there are two types of barter system. I give a product. So generally, this is very prevailing across this wholesale market. Today, I may procure, both these wholesalers sits next door, they will procure it from a common guy outside his place, and they will have a lot of stocks. Suppose a wholesaler comes and asks him for a product which is not there, he may go to the next door and get that product and give it to this guy. And he will give it once he gets that product, similar product to him. So this is called a barter system. So if it is of the similar quantity or similar product, you need not make any adjustment in the books. Okay? But if I give a product, giving an X product and gets a Y as a this one, first one is what I have received as a fair value of the Y has to be considered for revenue recognition. If that does not have any fair value, then I have to go back to the what I have supplied. So the priority of line is what I have received. What is that fair value? If it is identifiable independently, then I will recognize that basis as cost as well as the revenue. If I am not able to do this, then I will go to the what I have supplied. The secondary is what I have supplied, because I always be biased when it comes to my own supply. So that's why this criteria of coming, what you have supplied, that becomes the fair value for recognizing that transaction. So this is more from the measurement perspective, nothing to do with the recognition principle. Recognition principle will stay, you have to pass on the performance obligation, you have to satisfy everything. That condition will stay. How should I measure the revenue? How should I this? There is a complexity. If it is only a barter transaction, it is not happening through a cash or a commercial transaction. There are ways to say all these things. So this is very significantly operated in the advertisement industry, where the barter transactions are very common, where they provide services and they give the goods, they give the prices. In the media industry, where the advertisements, one way it gets compensated by way of money, and other way is like giving gifts to them. This IPL, where they give a lot of benefits to the players as well as to money to the BCA. So there is a consideration goes in two different ways. One is by way of a barter, and second one is by way of a commercial transaction. So you need to record everything as a cost and everything as a revenue from the other party as well. Clear? I mean, this is slightly goes beyond logics, which we need to appreciate a little more deeper. I mean, it has to be. You have to go through every transaction individually to ensure that every aspect of the transaction is getting covered in the IPS. Financial services, we have already spoken.
Barter transaction. What if there is identical goods?
Identical notes, you need not do any. I mean, it will be a cost. This one. That is what it is.
There is no recognition.
No revenue, no cost. It is more of just a giving and taking. So these are all the disclosures which we need to give it as part of the financial statements. I said last concept which I wanted to cover is the PPA. PPA is generally a power purchase agreement, which is like I would have constructed I will give you an example of an electricity company. Okay, they will construct a plant in a place where the TNEP has approved. So they will enter into a PPA agreement through which they will be paying a fixed amount. At the end of the term, they have to leave the plant as it is TNEP and come out of it, which means I have a right to use that plant for 30 years. While I have constructed it, I have identified the area, I have done everything. By way of entering into a PPA, what I am saying is, I will hand it over this entire plant to the TNEP at the end of 30 years. Over 30 years, whatever is the benefit, I will get it. So this is, once I construct it, it becomes a right to use. I don't own this asset in my use. So this is totally gets into a different, this will not be a fixed asset, this will be an intangible asset in your book. This is a significant change. This is not covered by the revenue recognition principles in this one. So there is a separate revenue recognition. What is that? I am getting this as a revenue. So there is a conceptual change from a fixed asset to an intangible asset. This is what the PPA says as part of the. This will be very common in port developers. In port there are various types of cargo handles. There are vehicles which will handle only the cars, everything. So each of this has its own right. They have a right to use. They don't have a permanent establishment there. So it is more of a temporary. So this is called right to use kind of an.
All DOTs are covered.
All DOTs are covered. All DOTs are covered. Any other questions? This is the last slide. I don't have anything else to say. I'll be happy to take any questions now. And it was very pleasure talking to you. And I got a lot of inputs and insights, a lot of questions, very interactive. Thanks for giving me an interactive session. If you have any questions, you can shoot out to me and I'll be here. You can reach me in my mail ID. I'll be happy to answer all your questions. Not only on this topic and any topic. As far as possible, I'll try to come out with an answer. If not, I'll try to do my best. Okay. And you can always reach out to me. I have nothing. Anytime you can reach out. Any other questions? I'll be happy to take.
See, you said that PPA covers all the things, but the thematic classification assess data first. You don't know whether
It will be right to use kind of thing. Right to use.
is now India is an IFRS India is one.
So there is no significant 115 and this one. That is very
It is
conceptually same, but there are a lot more differences. So in case of land, I will just give you an example. If it is a land, in your EOC method, you would have incurred the cost. Suppose a land is being purchased for constructing a retail investment, you would have incurred the cost. Technically, the land use is not only for these blocks, it is for the entire development. So land has to be amortized over the project period. So this is a significant shift from what we are looking out in. So this is one just simple change, but there are a lot of changes like this in this country. So I don't think 115 as a concept we need to consider it. It cannot be covered with this. It will be too heavy.
We can have a separate session.
I'll be happy to have that, but we will see. I'll surely try to make it up somewhere else. Any other things? Any other questions?
For the surface.
So, SNC, handing over